Distinguished guests, ladies and gentlemen, friends, thank you all for being here. My name is Hannah Wanjia-Ryder. I'm the CEO of Development Reimagined. It's a pleasure to welcome you with our partners, AUDA-NEPAD, the Alliance of African Multilateral Financial Institutions, SAIIA, South African Institute of International Affairs, and one campaign to this event. Also ACET, the African Center for Economic Transformation. There's a good group of us who have come together to organize this event, Cutting the Cost of Capital, Financing Africa's Infrastructure. So it's my pleasure to welcome you all. I will be overall MC for this event, but in particular, I would first just like to let you know that this event is going to be recorded. It is not a hybrid event, but we will be putting the video out once it's completed, and we hope that you will be able to circulate it on your networks and therefore also be able to access the insights that we have gathered today in this room for action, which is the most important thing. We're all focused on action. So with that very brief logistical introduction, let me pass over to my dear friend, Ms. Pamela Gopal, who is the Senior Program Officer and lead for the African Policy Bridge Tank at the African Union Development Agency, AUDA-NEPAD, to introduce the substance of this event and give us her welcome remarks. Thank you, Pamela.
Thank you very much, Hannah, for that. And good morning, distinguished guests, colleagues, and friends. It's good to see a full table today. So it is my pleasure, and on behalf of the African Union Development Agency, NEPAD, and our partners, to welcome you to this important dialogue on cutting the cost of capital, financing Africa's infrastructure. Today's gathering is not about just financial numbers or debt ratios. It is about redefining how value is constructed and who gets to define it. It is about shifting the narrative from Africa as a high-risk borrower to Africa as a high-opportunity partner in the world today. We hear about the numbers gap, but behind those numbers lies a deeper story. And Africa continues to pay the premium on this perception. Credit rating biased and outdated methodologies have systematically undervalued our resilience, our reform, and our innovation. As a result, billions of dollars that have been used to build roads, energy grids, and digital networks are instead lost through mispricing and misperception. But Africa is not waiting just to be rescued. It's actually been financing its own future in some ways. And through the pension fund, mobile savings, cooperatives, and remittances, Africa's citizens are quietly investing in their own infrastructure every day. And such initiatives at the African Union Development Agency, NEPAD, such as the 5% Agenda, the APRM credit rating review mechanism, and the ongoing African financial architect reforms are proof that Africa's determination to build credibility through evidence is fundamental. Today's conversation must therefore move beyond managing risk. It must move towards measuring our opportunities, and we must view every successful infrastructure delivery as an act of diplomacy, demonstrating that Africa's development is not just a charity case, but a cornerstone of global sustainability and shared prosperity. When we look at the fibers that connect East Africa, the hydro projects in Central Africa, and the transport corridors in Southern Africa, these are not isolated investments. They are the arteries of global trade as well as climate resilience. To invest in Africa's infrastructure is to invest in the world's future. And it is partnerships like the ones around the table that will transfer not just capital, but also trust, skills, and co-ownership in doing so. As we discuss how the cost of capital affects us today, let us be reminded that Africa's credibility cannot be borrowed, but it must be built. And that process begins with this mutual recognition of Africa as both a financier and a frontier for innovation. In that spirit, I invite you all to approach this dialogue not as critics of Africa's risk, but as collaborators in this rise, because the continent that powers our phones, fuels our energy transition, as well as anchors our global supply chains, is not a risk, but a partner in renewal. It is my now distinct honor to invite our keynote speaker, Mr. Manuel Moses, who is the Chief Executive Officer of the African Trade and Investment Development Insurance, to deliver a keynote address. Thank you and welcome again.
Let me get my notes so that I make sure I don't forget anything important. Thank you again for the kind introductions. My name is Manuel, the CEO of ATD. ATD is Africa's trade and investment political and credit risk insurer. Thank you for inviting us to this very interesting subject of cutting the cost of capital, because capital is a key ingredient to the development of the continent. ATD approaches this issue by trying to manage the perception of risk versus the reality of risk. Unfortunately, yes, Africa gets its fair share of the perception is higher than the reality. When we look at the numbers, by all studies, either by the African Development Bank, by the World Bank, the risk premiums that we pay in the continent are higher than the reality of the risk, because the records show that the defaults in Africa are much lower than other parts of the world, and yet we pay the price. And of course, part of that cost of capital, let me try to break it down. First, as an individual, I think we all have a credit score, all of us. Whether you know it or don't, you have a credit score. So depending on your credit score, your bank will look at their cost of capital and say, we raise deposits and we are paying, let's say, 2% to our depositors. And then they also look at how much it costs to keep the lights on, to keep the branches on. They call that the cost of running the business or operations. They say maybe another 1%. Then they then look at what they call the cost of the risk, which is the cost of capital. That one now depends on your credit score. So if you are paying, let's say 5%, let's just say assume 2% was paid to depositors, 1% was to keep the lights on, the other 2% was dependent on your risk as an individual. It's true at individual level. I'm trying to break it down so that we all understand what we're talking about. The same is true for companies. The bank will look at the company the same way. They will look at what is the risk premium for this particular company. There are good companies, there are bad companies that, depending on their record, will be charged more or less because of their riskiness. Same is true for countries. So when we look at our country, someone is trying to invest in a country, they look at the same things. So cost of capital is, you can say, the more subjective part of how the bank prices or how an investor prices it. So it's very, very important that we accurately measure it. Unfortunately, and it will be discussed today, that rating agencies play a key role in that. They decide this person or this country or this company is rated this and that sends a signal to the bank or to the banks that says, okay, depending on your rating, this is the price you pay. So it's very, very important. It's a huge responsibility that has been placed on rating agencies, because it can cost literally billions of dollars for a country if they don't do a correct rating. So there is always the debate and pressure on them to say, make sure that your rating is as accurate as possible. Most of them are not based in the continent, unfortunately, so they struggle to get all the accurate data. One set of argument is that, do they really take into account all the nuances of our countries? Let's say, for example, a country is endowed, and Africa is endowed, for example, with assets of this new, you can say, transition. A country with forests, green forests, does it factor into the GDP of that country? Is that in the rating? How do we account for that? Because indeed, that country is actually rich, but yet when you look at the actual accounting numbers, it doesn't count. So you might rate a country with huge forest sinks is lowly rated, but actually it's contributing to the global economy. How do we factor those kind of things? These are the kind of nuances that we need to advocate for, to say really accurately reflect our ratings in the continent. I'm sure you guys are experts and you will debate all of these points more accurately than I can, but I wanted to give a sense of how these things work. So now I will just come back to the topic, but talk about how ATIDE has been trying to handle this and my sister organizations. So I'm here also, as a proud member of the African Association of Financial Institutions. I'm just speaking on their behalf to say we, as African institutions, have been trying to attract capital into the continent. We also struggle with the same things that you struggle with, to say how do we attract capital at the right price. We have been rated, and we are rated by these international organizations, and we try to give our ratings to the countries because we are highly rated, and therefore we can say, why don't we enhance that capital or blend our rating with that of the country, hopefully lower the cost of capital. But these are all, gimmicks of trying to lower the cost of capital for our countries. That's what we do, and hopefully our perception, our idea is that the first time an investor invests, they are relying on our rating. Let's say we are covering something 100%. The next time they trade, we would like to say, okay, now we cover you 80%. The other 20% you take it on your own, because really there was not a claim, there was not a risk, a reality of risk. So therefore, take some risk, and eventually, we lower and lower our coverage so that you get comfortable with the continent. That's the role that we are playing at AAMFI in various shapes and forms, to basically introduce people to the risk of Africa that actually you are afraid of. The risk that you're afraid of does not exist. So that's what we try and do as institutions. But hopefully one day we are working very hard so that the investors won't need us. So we're working every day to make ourselves irrelevant, because Africa's risk is mispriced. That's the concept. Now, there is also the other side of, our own countries need to do their part. We have, I know with your challenges, I think AUDA-NEPAD have already explained the numbers that we are talking about, the gaps. We have got huge infrastructure gaps. Name it, in any sector, infrastructure, roads, whatever. We need so much funding. So if we also utilize the resources that we have acquired, taxes, we are funding ourselves, like you said earlier on. We can use those funds efficiently. We indeed can finance ourselves, because at least the funds raised in Africa, they don't have that perception of risk and reality of risk, because we are already taking the risk. We are already in the continent. So maybe that is the solution, to say African investors, African capital has already taken the risk. So why don't we tap into that? Because there we don't have to convince anyone to bring capital to the continent. So I think that's the appeal to the African governments, African investors. Please let us finance ourselves, because I think it's the theme of the world right now. Everyone is taking care of their own. Let us also take care of our own. And there, the perception and reality of risk is probably less. So that's the appeal to our own, side of the equation. So we all have a role to play. I'm sure this table, the experts around here, led by Hannah, will be able to unpack this issue of how can we cut the cost of capital. There are many factors. I think I've tried to explain them. But you guys are the experts. You know better how to articulate and to advocate for the right type of ratings. Of course, we can also have another vision is let's create our own, and thanks to AUDA-NEPAD and AU to create our own rating agency. That helps, but it will just be one of the voices. That will be there. It's good to have that, and it's good that we can also promote that. It will add to the debate, and it should be fair. It should also accurately reflect our exact situation. Those who are defaulting, please pay. You don't create, it's at individual level. You don't create a good record if you are defaulting, but it's very rare in the continent. So I think we suffer from the perception of risk that is higher than normal. I could go on, but I'm not an expert. All I can do is to challenge you, debate this, and really come up with concrete actions that help to address and advance the issues that we are going to articulate and discuss today. And I thank you so much for inviting me and being part of this conversation. Asante sana.
Thank you so much, Mr. Moses, for your remarks, your speech, encouraging us to problem solve today, which is exactly what we plan to do. We're always in a setting of trying to find solutions and implement them. And we know that organizations like a TD and of course AUDA-NEPAD and others are in the space of making that happen in terms of taking action. So thank you very much. The next part of our agenda is going to be a initial discussion with a set of excellent panelists. I'm afraid one or two have not been able to join us, which means we'll have more time for discussion with the other experts in the room as well, and also Q&A, that's not necessarily a bad thing. But nevertheless, we will miss their presence, but we still have some excellent speakers and those who will give us some great insights today. In particular, let me introduce Mr. Babajide Sodipo, who is the Acting Executive Secretary of the Alliance of African Multilateral Financial Institutions. Mr. Sodipo, thank you for joining us. And obviously we referred already to the Alliance, and we will get a bit more discussion of that and the various roles that the different African multilaterals can play in this space through him. I'm also very pleased to welcome Dr. Lina Benabdallah, who's the Associate Professor of Politics and International Affairs at Wake Forest University. And you'll be giving us insights in particular into some of the political constraints, but opportunities as well in terms of cutting the cost of capital, especially for African infrastructure. So we're going to kick off the discussion, and I'm also going to, of course, welcome insights also from Mr. Moses and also Pamela Gopal as well as we continue, and then I'll also open up the floor for questions and also comments from yourselves in terms of how we take this forward. But let me kick off with you first, Babajide. African governments are the largest contributors to infrastructure financing on the continent. There is a misconception that multilaterals are or China is, etc. But African governments, as far as our analysis of development Reimagined is concerned, we find that they are the largest contributors for infrastructure financing. But African multilateral financial institutions have also played a considerable role. What role is that, Babajide, and what advantages do African multilateral financial institutions have when it comes to financing infrastructure in particular?
Right. Thank you, and good morning, everyone, and thank you all for coming to this very important session. Maybe just a slight reintroduction of the Alliance of African Multilateral Financial Institutions. It is the platform or the grouping of African financial institutions that were created by African states, meaning they were negotiated by treaty and created to address critical financing gaps that face the continent. So basically, over the last 30, 40-year period, um, African countries observed, of course, that certain elements of the multilateral uh, financial systems were not working for the continent. Certain elements of the global financial architecture were not really addressing the continent's financing gaps. And over time, they have gone ahead to capitalize and create specific dedicated institutions to address those gaps, including institutions like ATIDI, which Mr. Moses spoke very well about, the African Export-Import Bank, the African Finance Corporation. You also have some of the more regional ones like the East Africa Development Bank, the Trade Development Bank for Southern and Eastern Africa, and a number of these institutions with different kinds of tools, different kind of institutions. You have the banks like AFC and Afrexim Bank. You also have specialized institutions like ATIDI, Africa Reinsurance, and so on. So essentially, these institutions were all created to address financing gaps. And of course, one of the financing gaps that the continent has always had, since I'm sure before almost all of us here were born, actually, we can be sure, if the infrastructure financing gap has always been an issue. We're just hoping to at least start addressing that. So you could say that a number of these institutions were created exactly to address that, to address these infrastructure financing gaps, as well as the other constraints to growth that have faced the continent. And in the past, like I said, uh, 30 to 40 years of the existence of these institutions, they've grown from zero to a little to very significant. And I think, like Hannah said, at the moment, after you have the African governments themselves financing infrastructure on the continent, the second largest or the second highest financiers that is not the Chinese, is not the World Bank, it is actually these African multilateral financial institutions who play a critical role in aggregating one African capital, because we must recall that these institutions were set up and capitalized by African countries, African capital, both public and private. They also serve as intermediaries in channeling investment from partners, from China, from the traditional multilaterals, from the private markets, most importantly, into the critical priority areas of the continent, including infrastructure. So you could say that their role is growing and is still growing. If you were to look at the charts, I'm sure which Hannah alluded to, you'll see that the financing that these African multilateral financial institutions have channeled into infrastructure has grown from year to year. And given the kind of gaps in the infrastructure stock on the continent, you can expect them to keep playing bigger roles. And even given the constraints that a number of African countries are having with debts, which is on their books, we can expect that there'll be more that will be expected from these institutions to reduce some of the load on these governments and really channel them. So, in terms of the specific role they've played roles in not just channeling and bringing these investments from different partners, different parts of the world, but we've also been extremely creative in the way we have tried to address this financing gap. So, first of all, for African multilateral financial institutions, They don't have any option. It's not as if when business in Africa is not good, they can decide to go and finance things in Asia or in Europe. It's Africa or nothing, right? So absolutely, they have a very different relationship and appreciation of African risk because it is all they have. It is all they have to deal with. So it means that they are much more incentivized to come up with ways to address this risk issues, which address the cost. So you will find out that from institutions like the African Finance Corporation to institutions like ATIDI, to institutions like the Afrexim Bank, some of the most cutting edge, some of the most innovative methods of squeezing as much value from a dollar in terms of financing infrastructure, you will find with these institutions. For example, Afrexim Bank is working on, and I'm sure on a concessional fund which it is funding from its own profits. So it's not reliant on donors. It's not reliant from the markets per se. And because it's using from its own profits, it's able to make it concessional. And part of the core objectives of that fund is to finance the enabling infrastructure around large industrial projects. For example, you would have heard the stories. Dangote wanted to build his refinery. Part of the reason why the refinery was so expensive was that he had to not only build the refinery, he had to build the roads that lead to the refinery. He had to provide electricity infrastructure. He had to build jetties and the ports, which ordinarily these are things that should have been borne by the government. But of course, for any project developer, because you have to take care of these things too, it really increases the costs of the project to prohibitive levels. So Afrexim Bank, as an example, is coming up with a way to be able to use concessional financing to address those enabling infrastructure to bring the overall cost of the financing down. And I think that's just one example of a creative method, which I'm sure we'll discuss. Thank you.
Right, yes. So your answer is AMFIs have to be there. There is no other option. But also a degree of creativity, but also listening in a sense to what, or searching out there for the right, for the infrastructure project. I mean, Mr. Moses, I would, if you want to come in here as well on that question, because obviously you run an African Multilateral. Would you agree with that? Is there anything else that makes, because is it just because you have to focus on Africa that you actually go for those projects and really try to overcome the cost of capital? Is it because of that driver, or is it because you're actually trying to create some more creativity that maybe other banks should be learning from you, or other institutions should be learning from you? What is it?
Thank you. I think you have hit on the nail. We have got no other continent to go to. So we are out of necessity. We have to be innovative, creative, and find solutions to our situation. This is what we have been doing as a continent. I will give another example of the past crisis that the world has faced, which was the pandemic. Again, we found ourselves on the lower end of the system, whereby we could not access drugs because other people had got in front of us, they had placed orders, and we were trying to be in the queue. So without the right numbers of orders, we could not, order the vaccines. Again, we had to, thanks to the African banks and others, think through that and say, how can we mobilize a large enough an order to attract,
Yeah.
the vaccines for the continent which we were severely needed. So we had nobody else to help us, but we had to innovate and find a solution to that particular crisis. today we are also, we've got other existential, issues. Talk about climate. One could say, Africa did not contribute to the climate issue, but it is actually the victim today. We are facing the consequences of, severe droughts, severe floods, depending on which part of Africa we're in. And we are also trying to innovate around it because we cannot wait for the world to come and help us. We have to help ourselves. That is the mentality we have. Another crisis which is emerging is the debt. I think Jide has mentioned it. We are sitting on very high levels of debt in the continent. Countries are getting very constrained in terms of their fiscal space. We need to think again as African Association of Financial Institutions, how can we help countries create more fiscal space? How can we be innovative? Give our countries that fiscal space, reprofile their debt, give them more space so that they can actually do the things that we need. So we are doing this out of necessity, and others can come and help us, but we have to be in the lead.
Dr. Ben Abdallah, I want to bring you in here. We talk about sort of collective action, necessity, African governments also financing infrastructure themselves. What is, we still have so many gaps in terms of infrastructure. What is it, just the cost of capital that's the impediment, or are there other political challenges that we have to face, or economic challenges beyond the cost of capital in order to finance infrastructure on the continent?
Thank you so much, Hannah. Good morning, everyone. Thank you for having me today. As an academic, I always feel that these opportunities are amazing learning opportunities to hear from the actual experts. Myself just think too sometimes more about the bigger picture than really about sort of the challenges on the ground. However, I think this question of the impediments to especially cross-border infrastructure, I think is a very good question, and at times really sort of kind of when we're thinking about problems, sort of understanding the problem sort of is half the task in terms of really figuring out what specifically actions to take to solve the problems. And so I think when it comes to cross-border infrastructure, just by definition, right, we're not talking about just mega infrastructure projects within countries contained within specific borders, but cross-border. So we are really, in a way, increasing sort of the challenges. And in the way I think about it, I will offer three different types of impediments that I think need to be kind of understood and tackled as we are thinking about this cross-border infrastructure. So I'll talk about the domestic level, and then the regional level, and then the sort of systemic international level. Domestically, obviously, sort of these cross-border infrastructure projects, when we think about them, they are infrastructure projects that by definition take a long time, right? So they are projects that are not short-term investments. They are long-term investments. At times, domestically speaking, you'll see politicians perhaps prioritizing projects that can be finished within a much shorter period of time because they can be visibly celebrated, they can be showed as achievements that have been reached. Sometimes cross-border infrastructure projects can be too big to be included in, let's say, a 4-term or a 5-term plan for politicians to actually prioritize. And they might prioritize perhaps welfare-related infrastructure, perhaps kind of health-related infrastructure over cross-border infrastructure because, again, when we think about it from a political kind of agenda setting and achievement of results, cross-border infrastructure might not be prioritized, even though we can sit here and outline all the benefits that countries can reap from sort of creating these cross-border infrastructure. When we think about it politically speaking, it's not always prioritized precisely because these are long-term, and sometimes we're thinking politically speaking, we're thinking short-term. We're thinking short-term around 4 years, maybe 5 years max, and sort of these are multi-decade kind of long-term infrastructure projects that sometimes might not really meet the political realities of some of these countries that we're talking about. there is, of course, here, domestically speaking, whenever we talk about these cross-border infrastructures, infrastructure in general, there's need to kind of the need for the infrastructure needs to align with what populations need, with what civil society organizations are needing, with what sort of stakeholders we want to see with these infrastructure projects. It's not always the case that politicians are able to get the buy-in, right, from stakeholders domestically to get these projects rolling. We can come back to some of these impediments in the domestic sphere, but for the sake of time, I'll move to the regional challenges. And some of the points that I meant that I'm thinking about here were already mentioned, but most perhaps importantly, when we're thinking about sort of cross-border infrastructure, it needs a lot of coordination. I mean, this kind of a no-brainer, and coordination across different monetary policies is what I mean. Sort of different countries will have different setups in terms of their monetary policies, and the structures of the financing for repayments, for instance, for all of these loans that will go into the cross-border infrastructure projects. The lack of coordination mechanisms. I mean, of course, when we speak about regional institutions in the continent, as you mentioned earlier, Pamela, in your opening remarks, the AU and other regional institutions have really provided the supportive frameworks for this, for infrastructure projects. But despite that supportive framework, there's lack of perhaps enforcement, right? There's lack of mechanisms that will get countries to sort of commit to the communication and the transparency, especially that is needed to sort of coordinate these cross-border, infrastructure projects. And so these enforcement mechanisms of fiscal kind of support is lacking from the regional institutions. It's not that it's not there altogether, but it's just not enough, again, because these cross-border infrastructures are just mega infrastructure projects by definition. And then I'll move here to the systemic challenges. And obviously, even though a lot of these challenges I was talking about are more related to policy, related to the sort of the political aspect, when it comes to systematic challenges, my colleagues and have already spoken about sort of one of the most important challenges here, which is the credit rating systems. So these are systemic challenges that the continent faces when we have biased systems that are ranking and essentially costing or leading to higher interest rates, and costing the continent a lot of investment because of the bias that's kind of already kind of baked into these rating systems. It remains a huge systemic challenge, right? So for these cross-border infrastructure projects. The other thing is sometimes also geopolitical rivalries play out in interesting ways when it comes to cross-border infrastructure projects. We see, initiatives like Global Gateway, the Belt and Road Initiative, PGI, all kinds of different initiatives that a lot of it is kind of thinking on and planning for these kind of cross-border infrastructures, railways that cut across different different countries in the continent. But oftentimes these cross-border projects, they reflect more the interests of the funders or these kind of geopolitical rivalries than they do the interest of the people who are from these countries where these projects are supposed to cut across. And we've seen time and time again where we have these massive railway investments that are not necessarily used by local people the way that they are envisioned, because there's a lack of actually taking into account what the interests of African peoples are and what the stakeholders from the African side really want to see out of this. Instead, we see these projects that oftentimes connect ports to mines, connect mines to sort of the chain supply. They feed into bigger geopolitical rivalry interests of the funding agents and actors as opposed to the stakeholders from the African continent. So this is just to set up some of the challenges.
So it sounds like what you're saying is the cost of capital on the continent is high in general versus other places. However, when it comes to cross-border infrastructure, for all these different types of reasons, the cost of capital is even higher. And this is a real issue because it's not only that there is a infrastructure gap on the continent, it's also that we're trying to integrate. And so if cross-border infrastructure projects are even more expensive than other projects across the continent, then this creates its own dynamic and challenge. And it sounds like as well that, I mean, you mentioned some of the systemic issues, and I would really like, I would love Pamela to also come in on this, and our other panelists as well. Um, I'm gonna hold these guys for a few more minutes before I come to you, please, if you don't mind, just for a few more. Um, there are also aspects such as, for example, where certain countries can access certain types of finance, certain levels of concessionality of finance. We're here at the World Bank IMF annual meetings. We have, IDA eligibility or none. Or you have to go to IBRD. I mean, also for AFDB, it also has those types of those thresholds. Um, that's also potentially an impediment, especially in terms of, because different countries have different costs. Are these also issues that you come across? Do the AMFIs have these thresholds? Do you use those sorts of categorizations? Does that help you finance infrastructure a bit more easily? And and even the question around credit ratings,
No,
can
no,
you overlook some of those questions?
no, I think generally the attitude of AMFIs towards African states, it's not to discriminate and say some states are more special than others, to the extent that you are a treaty member of that particular AMFI, then it means that, of course, the AMFIs are obligated to address those needs. And I think that is part of the difference between AMFIs, which are established, capitalized, and owned by the African states. In other words, they are sort of like borrower owned and capitalized financial institutions, and the multilateral financial institutions, whereby the decisions are really being made by countries that are not really the main beneficiaries of those services. So you can imagine then that their approach will be sometimes a bit more prescriptive for reasons that I think will make perfect sense for the people capitalizing it, for the people, for the countries bringing their taxpayer funds to it. So it certainly makes sense that if I'm using my taxpayer funds to capitalize or to finance certain aspects, there will be conditions that my taxpayers would want to see attached to that financing. But the orientation of African multilateral financial institutions is very different because again we are ourselves and we're just really laser focused on solving the problems and addressing the issues without making it too complicated.
Okay. Yes, please go ahead.
Sure. I think just to add to what Jide said, on our part as an institution, we don't have that type of categorization of your IBRD or IDA or ADF or AFD windows. No, what we do classify with is, are you a member or not? So for ATD, we have now, on paper, since we're a AU affiliated organization, all African countries are eligible to join. To date, we have 24 countries that have joined our organization, where we are able to do more than we can do in the non-member countries. So we are we have a smaller window for the non-member countries, basically telling them that if you join, your envelope becomes bigger because you are a member. So, but for those who are members, we don't even distinguish whether they are highly rated, lowly rated, they are in difficulty or not. We focus on the actual need and look at the riskiness of that particular issue. That's why we would boots on the ground. So we would do transactions in a country where people will say from a distance, how can you do a deal in such a country? Because we understand and we know how to really, measure the riskiness of that particular opportunity and structure around it and still do it, despite what, the macros and those issues that we're discussing here. They could be there, but we still do transactions in those countries. So yes, I agree that it's a binding, constraint, because the country that gets these resources more certainly should maximize on that. I would always tell a country, if you can get all your IDA money, please get it, because that's the cheapest source of money that you can ever get. Don't leave a cent. That's why they're here. Get everything, take it to Africa and use it efficiently. Thank you.
Yeah, especially on infrastructure projects, most
Yes.
certainly. Pamela, maybe we can just finish with you before we go to the rest of the audience. Do you think the cost of capital has been a significant impediment when it comes to pulling together PIDA projects and delivering PIDA projects?
Absolutely. I think we also must not find ourselves in a trap where we say we have the solutions, but all we're doing is postponing the problems. We're talking about infrastructure and financing, but we shouldn't forget that it's also about people. In rural Africa, women walk miles to get water. The young population are migrating, not because of their lack of ambition, but because they want to find opportunity. When you spoke about Dangote and wanting to, have his manufacturing plant, but having to also build the infrastructure to take it, I mean, these are a typical example of public-private partnerships where they have to engage with government, and it's not a bad thing, because I think it's up to our private sector, our African private sector, to do so, and leverage from that. In terms of when also to just demonstrate about how the cost of capital and why we need to move in the continent, and it's the way it's arranged with the speed and pace. When in South Africa we experienced the uprising, when we had the uprising of the and they destroyed the infrastructure. By the time governments deployed the army, it was too late. And only to say that it's the people that rallied together to build this infrastructure or to clean up what was destroyed. And the African Union Development Agency is working with the Development Bank of Southern Africa also. The cost of capital, there are very many ways of how we do it: co-financing, project preparation, etc., so that we know how to deliver on basic amenities in when it comes to providing water, energy, in the Southern Hemisphere. I can talk, about that, and a lot of good things that the African Union has done in terms of infrastructure. It's not enough, and the speed and pace is fundamental.
Thank you, Pamela. We deliberately set this up as a roundtable so that we would have a dynamic and engaging, interactive conversation amongst everyone in this room. So now, having had this scene setting, and a very detailed, I think, scene setting, it's over to you, who are here around the table. Do you have questions for our panelists, reflections, also from your own experience of working on cost of capital and infrastructure issues on the continent in particular? Please give us your questions. We have, for those of you who are not at the table, I know there are still some seats, so please do take a seat at the table, but alternatively there are some roving mics, so please just put your hand up and my colleagues will help you with the roving mic. Yes, we have one question here immediately. Reflection.
My name is Phil Southwell. I'm a partner of a firm called Chapel Hill Denham, African-based, Lagos headquartered. And I think a lot of the discussion we've had this morning, suffers from a lack of data. But if I can sort of frame that a little bit, in Nigeria, we have 4 gigawatts of grid power, but we have 35 gigawatts of self-generated power. And so when I hear a position where governments and where DFIs are the principal sources of capital for infrastructure. That isn't the world that I'm living in as I travel around Africa. And I feel that the larger sources of capital for infrastructure are private individuals, are private companies. They may not do that in sort of neat transactions which go through financial close and what have you, but that's how it's working. 2-3 other comments and then I'll sit down. The first is one of FX. Every G20 country finances their infrastructure in domestic currency. Mm-hmm. And I'll explain what we do. That's what we do. But we have so many projects, even projects supported by DFIs based on the African project, financed in someone else's currency, and ultimately impoverishing the users and the financiers of those projects. Second thing is that we need to use capital markets. Capital markets are a way of attracting institutional capital. My night job is as chair of the investment committee of Nigeria, one of Nigeria's largest pension funds. As a pension fund, we can't invest in these projects direct. We can invest, if we're presented with a product that is listed on a capital market, and we do. One of the most successful users of capital markets would be a municipal, Lagos State. For 23 years, they have issued infrastructure bonds, all in local currency. All of those bonds, investing in pre-identified projects. Mm-hmm. The state doesn't touch the money. It goes to a trustee and direct to the project. They're not allowed to reissue until the regulator has visited those projects. So those types of structures are really very successful. And so I think one needs to look at those types of that sort of approach. Yeah. 10 years ago, we started the Nigeria Infrastructure Debt Fund. We've raised 11 times since then. We've financed over $600 million of projects. I think we've been very fortunate to have Africa Development Bank invest in that. But they invested in the 6th round. So the real strength of that of that product is that every single pension fund in the country invested in it, and it has been able to deliver a CPI plus return. And that cost of capital is, I think, very, very attractive for for anyone investing in infrastructure in that country. And because we have adopted a closed-end fund structure, we have no redemption risk. Our longest loan is 21 years. It is very hard to be able to provide that kind of capital unless you use structures like that. We also have an infrastructure equity fund, which only invests in operating assets. So the final comment I'd make is I would challenge anyone to identify an infrastructure asset in Africa that is listed recently. If you can identify it, fantastic. But we need to find exits for all of these investments into infrastructure. An infrastructure investment shouldn't be a prison sentence. You should be allowed out. And the way to get out is to use capital markets and to encourage the IPOing of those types of assets. So I think governments, multilateral financial institutions should be focused on developing domestic currency capital markets, enlisting all of their assets to be a warehouse, not a long-term owner of these assets, and that would make everyone else find themselves in a position where they're far better able to bring those assets to market. Thank you.
Great, thank you very much. Some really important work that you've been doing with colleagues, and I wonder what your responses are to that, and are there any other perhaps some innovative instruments as well that you've been working on, which perhaps echo some of these points around FX and
I
capital markets?
fully agree with him. Actually, old enough to remember how the Asia crisis, caused a lot of problems in Asia, and their response then, because of the dollar and they were OPEC to the dollar, they realized that they could not develop until they developed a deep Asian capital markets. So this is how Asia solved their problem. I'm happy to see that Nigeria is doing that. South Africa is also another one with a deep capital market. And you cannot develop a continent without a deep local currency market. I think I mentioned it in my earlier remarks where we say the investors who don't have a perception of risk versus a reality of risk are the local investors because they've already taken that risk. So they really see the opportunity. Now the question is, how do we tap into these pools of savings, pensions, insurance? How do we make them channel their savings into critical projects? And what you are doing is excellent, and we should try to say now, please do it for the neighboring countries. You are solving for Nigeria because you've got a deep capital market. Let there be something that you raise funds in Nigeria but invest in Cameroon because it's just next door. You have got the depth. Same with South Africa. Deep capital market. It can be used. You can raise funds in rands or in naira and develop the region because really we don't have to actually raise money from across the world because we have deep pools of capital in the continent, and slowly we start to integrate and we create that one big market. So I fully agree. What we are doing as ATD, again in Nigeria, is to work with some of the infrastructure funds, the infra credit, where they are also have a good pipeline of projects that need a long-term currency, and we have been helping them to lengthen the tenors of their offerings. Again, solution of use local markets to develop local infrastructure projects. So fully agreed. I don't know which other countries deepen up. Kenya, for example, Egypt. Those deep pools need to really start to become deepened and help the continent to raise resources for the continent, by the continent, and create lower cost of capital for those projects to happen. Because tenor and FX are the issues that people face.
Go ahead.
Thank you very much. So the other thing that AMFI does, and which it is well positioned to do, is advocacy and engagement. And of course, Mr. Moses will confirm that one of our priority is not just about AMFI; it's about the strengthening of the African financial architecture, right? And that goes to the sense of how do we create the necessary plumbing which can enable capital move across the continent in much more effective and efficient manner, whereby I think, like you said, for a really moderate sized project, must you go look for foreign investors, whether they're Chinese or whoever, to do something you can really do in your local currency. And in the coming months and years, it's an agenda item which we are prioritizing for our engagements with the African Union, and we do expect to be able to see some movement on the regulatory side around a single African financial services market, consolidation in that area towards the ultimate objective of deepening the African financial pools, being able to aggregate capital across the continent and really reducing our cost of finance. So absolutely, I'm sure you'll be hearing from us and other players in that group on how we can do the necessary policy engagements to be able to address this, because some of them are really important policy issues.
We have some other questions from around the table. Yes, please go ahead. Please introduce yourself as well.
Good morning. My name is Frida Yawson from ACET, and apologize for the voice. I'm a little under the weather today. But ACET, as you know, Hannah, works on some projects like the G20 Compact with Africa that has a number of African countries struggling with some of these same issues. And so I'm very happy to hear what he mentioned about the cost of capital and all of that. But I have two quick questions. One of the things I heard recently from a developer is that Other regions are a bit more attractive because it takes too long to get some of these projects underway on the continent. Some African projects, infrastructure projects, could take 10 years when you can go to Brazil and get it done for 3 years, right? And I think some of these things also contribute to the perceived risk and the costs, etc. Some of that is either structuring the deal, feasibility studies, have you. I'd like to know, for both ATIDI and AMFI, what are some of the practical solutions that you can offer to help shorten these project development timeframes? And then secondly, at AUDA-NEPAD level or other, how do we improve this for cross-border projects? How do we improve the enforcement and coordination that is required to do these legal deals to structure these cross-border projects? So basically for everyone on the table, there's something to answer.
Some very good questions there. Who would like to take those first? The structuring is an issue, isn't it?
Yes,
Because you basically have to break a cross-border project is broken up into it might look like one project, but it ends up having to be broken up into several sections again.
Yeah.
And that creates a significant, that effectively accumulates risk, adds up risk rather than flatten it.
No, I fully agree, and your observations are correct. I actually used to work for an international multilateral, so I could see my teams working in Brazil and a team working in Africa. That I've experienced. It took much shorter to do it in Brazil than it would take it to do it in Africa. What I think is and how we should, I'm proposing a solution. How we solved it was that we needed to one, create templates. So I think legal documentation was always difficult. So we create legal templates, and the AUDA-NEPAD can help in that to say, listen, this is a standard power purchase agreement, say supposing it's in the power industry, that all countries must adopt, so that you don't have to each time start from the ground up negotiating it every time. So at least one template is agreed. And then, of course, if there is that template agreed at the AU level, let's customize it, domesticate it in all our countries so that it's clear. We also said, let us also anticipate the kind of questions that investors are going to ask. So investors are going to ask, oh, what is the payment record of this utility? How long does it take? Are they defaulting? So how can we make that data? I think someone mentioned data earlier on, very clear and available to investors so that they know, the track record of this utility is like this. We have a transparency tool that we are advocating. We are doing it in Malawi, for example, where we are just showing the payment record of the utility on its obligations, and that is made public to the investors so that they actually can price the risk correctly to say, you know what, Malawi pays on time. I don't have to, imagine that, put a fat on my premium for that payment risk. I know exactly what it is. So make that data available so that investors can price it correctly. And then thirdly, educate, in my view, the officials that negotiate with the private sector. What we've noticed is that you get a private sector who has got the top lawyers, with thick volumes and volumes of documentation, and they've got only one counterpart in the government, and he is overwhelmed. So the guy is shy to say, I actually don't know what this is, but he's supposed to be the one to decide. So there is no capacity on the government side, whereby the guy is he will not tell you that I'm overwhelmed, but at the same time he has to make a decision whether to sign or not. So in that uncertainty, he will not decide, so the project gets stalled. So there's a lot of work that needs to happen in project preparation to make sure that the government side is ready. So there's the legal capacity teams. They need to work very hard to train the officials that, listen, it's not a bad thing to say, I don't know, I need help. Actually, I don't know what these documents say, but I need someone to help me, and give capacity to the government so that they are equal partners and negotiate fair deals, because ultimately you want a fair deal that once it's out there, that's the fear of the government official. He was afraid that I'm going to be sacked because I signed a lopsided deal, So there's all that hesitation. But if he's equally competent, he knows what he's signing, he'll be confident and able to defend his decisions once the deal is out, so that there's equal partners. These are some of the insights I've seen in trying to get Africa to speed up turnaround of projects. But ultimately, data is important. Data is important. With data, we can solve a lot of problems. In fact, you can actually say, we also say other countries, in your tender documents, one more thing, in your tender documents, as you approach the market for this concession or that concession, ask the investors, we ask the government, put our name there to say, if you are looking for risk mitigation, there's Afrexim Bank to finance you. There's ATIDI to take some of the risks off you. If you are worried about foreign exchange risk, you're worried about expropriation, we are there to provide that type of solution. So you have a template of a package, that helps investors to say, tick, 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 and therefore they even sharpen their bids, and you can lower the cost of the transaction. These are some of the ideas we have. I'm not a solutions person, but definitely I've seen from practice that this is part of our problem. It's capacity, and ability to negotiate with very sophisticated people who are bringing top legal minds into the continent.
Pamela, you wanted to say something as well?
Thank you so much for the question from ACET. Just to mention that NEPAD mainly gets involved in, we're not responsible for building the roads and the bridges. What we do is facilitate these engagements, but more importantly, we facilitate the soft issues as well. We have a border efficiencies where we've put systems and digitalize the border efficiency so that trucks don't have to wait for weeks just to cross borders. There was another example on the Kazangula Bridge where, yes, the Chinese might have come in and built it with their engineers, but we had made sure that the local people were skilled and equipped on how they should actually build these bridges. So I think that we shouldn't lose sight on that fact. But also coming back to the cost of capital, we must understand that a dollar lent is not a dollar granted. And I totally agree with the ethics issue on using domestic currencies, because we often are building these. There's no the loans, whether it's financially viable or not, is not ascertained. We know what we need, but we are borrowing it at a phenomenal cost, and that is not often available to us. So I think we must make sure that when we borrow, it doesn't then ultimately make infrastructure absolutely expensive. We need to have a viability test as well as data, which I agree. Thanks.
A few other questions, yes? Yes.
Hi, good morning. My name is Need Simmons. I wear a couple of different hats. I used to work at the World Bank Group and the African Development Bank. There's been, I know a couple of times there's been it's been said about project preparation, how countries need to be, they lack the human capital for project preparation. I mean, when I was at AFDB, there was an African Legal Support Facility. I'm not an infrastructure guy or legal person, but there's that facility, and I'm not sure every country's tapping into that. It's there. I think there's a nominal cost to use it, but it's there, right? There's no excuse in this day and age where there's AI, data, all that. And then two, I don't know. Hannah, excuse me, but I'm gonna be candor. In this day and age, why are we still coming to these Western capitals begging for money? And then when I say that, look at what the Ethiopians have done with the Grand Ethiopian Renaissance Dam. It took them 20 years, but they built it, right? I believe I was told the Gulf countries put some financing in. There's local capital, but the diaspora was a huge contributor, right? And they're trying to provide technical assistance. But in this day and age, when this current administration has cut ODA. This should be a wake up call to us to say the days of doing development are not only over. We live in a transactional society where going forward it's going to be the have and have nots. They're going to be siloed. What are we doing as Wakandans for Africa? If I can say that, right? That's my.
Thank you. Responses from the panel, Lena? What do you think?
I mean, I think I agree 100% about the mobilizing diaspora. I mean, this is something that gets talked quite a bit about, but definitely we are in a geopolitical moment where essentially, kind of, I think Dr. Moses earlier in the keynote mentioned this is everybody's on their own, right? So we are also on our own. We are, we are faced with that challenge and the reality. Now with the funding of this ODI funding kind of shrinking more and more, it does present an opportunity to rethink basically how and where this capital should be coming from. Diaspora funding and capitalizing on that is a very interesting point. But I also think in terms of infrastructure in general, we think too much sometimes about the supply side and not the demand side, right? So we think about the actors who are involved in the funding, in the strategizing, in the designing, in the execution. But we need to also think about the demand side. We need to think about who are we building this infrastructure for? What is it for? Who are the stakeholders? In what ways? So putting those people at the heart of these discussions is extremely important to get into sort of efficiently building infrastructure that is going to be bringing benefit to the people who it is built for. So I think it's also really kind of thinking about the flip side of the coin and thinking about the demand side.
Absolutely. Okay, do we have any other questions from the floor? Yep, two more. Okay, yes. So, okay, please go ahead.
I got
And
Dennis Ferretti in CAFO Policy Institute from Cameroon. I think my colleague from ACET mentioned the whole issue of capacity, capabilities of state actors in actually implementing these infrastructural projects. I can tell you from Cameroon that in many of the Central African countries that capacity and capabilities are probably the most important aspect of this conversation. So I don't think it can be really minimized. The cost is there, but it plays a huge role in the way we see infrastructural projects evolve on the continent and especially in the region. The other thing is the execution, as you said, it takes a long time, being from capacity issues. Now, two things that I want to bring to the table. One is the whole issue of we talk about capital markets, but we haven't talked here about the challenges in actually developing these capital markets. So I would appreciate getting some thoughts from our colleagues on, developing the capital markets on the continent. Second point, an issue that I think hasn't come up also is the political economy piece of how our states operate. And even when we look at Ethiopia, the engagements between the governments and their diaspora is extremely important in how diasporas contribute to the country's development. And in many of our countries, there is a very ambivalent or not very good relationship between diasporas and their governments in such a way that many diasporans are absolutely not willing to put their money into a fund that is controlled by their governments. So there are issues like that that have to be addressed if we want to actually look at this issue clearly.
thank you very much. Great questions. Let me ask, Kareshi, do you want to also ask yours, and we'll have that as a final set of questions. Thank you.
Thank you, Hannah. My name is Karaji Sabani. I'm with the One Campaign. One comment and two questions. First comment is around debt. I know we spoke about this earlier today. And what we're seeing is on average about 17% of revenues that collected by African governments are going towards debt servicing costs. And this is the other flip side of the cost of capital. And there's an open letter out this week from a group of prominent economists calling for a move to sort of cap how much goes out on debt servicing to about 10%, and how a lot more can be saved that can be invested back into infrastructure. So that's the comment. Two questions, one to Pamela and one to you, Hannah. Pamela, I know AUDA-NEPAD is spearheading this upcoming financing summit in Angola in about 2 weeks' time. How do we see this issue featuring there? Are there any expectations we can see coming out from African governments on what they can do to tackle some of these issues around cost of capital of infrastructure, around infrastructure? And Hannah, for you, if most people don't know her, Hannah is a member of the Africa expert panel under this year's G20 presidency led by South Africa. And cost of capital is one of the main issues on the agenda. So if you could say a bit more of what we should expect with the Leaders Summit on the horizon, and how this work can continue as well, so that it doesn't end with the South African presidency. And we're expecting, just to be frank, a challenging presidency next year with the US taking over. What can we do collectively to make sure this remains high on the agenda? Thank you.
As moderator, I had not expected to be put on the spot. But so let me pass to Pamela first. But also, I think Babajida, you'd also say something about the Luanda summit as well, in terms of the work that you're doing with AUDA-NEPAD, perhaps. So, and also, yes. Okay. So yes, first. Okay. Yes, and then Pamela, and then Mr. Moses, please. Thank you.
Yeah, thank you very much. I think particularly on infrastructure, AMFI will be announced. Well, we've been engaging very closely with AUDA-NEPAD on how to come up with an integrated, holistic approach to addressing some of these challenges. The key advantage of AMFI is that it's a platform that brings all the players together, so it avoids a situation where you have to talk to each of us individually. And we are coming up with an arrangement which we will be announcing soon around how the NEPAD AMFI infrastructure financing facility, which will be some kind of joint framework between AMFI members and how the NEPAD for project identification, project development, and project preparation, as well as project financing, where we will be able to bring in the strength of all our members. Because if you do look at the AMFI membership, they have products and tools and interventions all across the entire financing value chain, from project preparation, development, to financing, to insurance, reinsurance, within the AMFI member space. All of that can be addressed. So absolutely, we will be announcing something specific around our collaboration with AUDA-NEPAD in the coming weeks. And I think, of course, the discussions around debt must be very well nuanced, right? Because in spite of the challenges, it is still a critical tool for investment for African countries, and it is clear now that what is really needed is a lot more investment for growth to be able to address all these development challenges. And I think we must sometimes be really specific that it's not as if debt in itself is a problem, it's the costs of the debt. And that in our engagements, we are not crippling or handicapping the ability of the countries to take on debt, because it is going to be needed. It's a fundamental thing that every country does. But the problem African countries has is that the cost of the debt is prohibitive, and it's not, in a lot of cases, truly reflective of the risks that are associated with those African projects and initiatives.
Thank you very much, Pamela.
Thank you so much for your question on the LFS. To take you back a little bit, before it was the Dakar Financing Summit, right? And if we go back to that, there was a whole homework. I think there was about 350 odd projects that were scaled down all the way to about 33 feeder projects. And over the years, what we have done is the best way to do these and implement it. And I take it back to the cost of, a dollar lent is not a dollar granted issue, is where we try to work with governments and get them to champion these projects. And when governments champion infrastructure projects, it moves at a faster pace than if we have to be, on the ground trying to make borders efficient, for example. So this LFS ahead of us is to address just that. What would it take to reduce the cost of financing these PIDA projects? Because we have the set of 33. We might have only delivered on 1/3 of the 33. And addressing this going forward into the week ahead is what NEPAD will be responsible to do, of course, with the partners around the table as well. Thank you.
Okay. Mr. Moser, do you want to take some of the questions, and also Lena as well? I think you could give your final reflection.
So I wanted to just address the issue of how do we create or deepen the capital markets. You are 100% right. So I've seen, countries that have gone that journey, Kenya being one. I think it starts with the reforms that acknowledge that capital markets are a critical tool of, domestic resource mobilization. So there is a need to create like a capital markets authority that actually regulates who can go to the market and who allows an instrument to be put on the market, because you can have people who are collect money from the communities and then of course default. So then you create now a negative perception of the capital market. So you need an authority that actually authorizes an issuance. So that it starts there. And there are programs from the African Development Bank, such as the one that he mentioned on the legal support. That is where you start. So approach the African Development Bank to say, listen, we want to create a capital markets authority so that we can now start to regulate how people issue in the domestic market. The World Bank has also another one, it's called the JCAP initiative, that also helps to create capital markets. So you do all the legal work, create the enabling laws before you start to allow players to tap into the market. And in that, in these initiatives for the African Development Bank and the World Bank, there is a big component of capacity building for the officials, the Ministry of Finance, the various ministries who have got projects, so that they know how to prepare, issuances and support. There's also capacity building for the market, capacity building for the pension funds, capacity building for the insurance companies. So it's a whole ecosystem. It takes a long time, but it's worth the investment. So if Cameroon is not on that journey, you need to advocate. Please, let's take it offline. We can put you in touch with some of the contacts that can help Cameroon to go on that path. But it's certainly the way to go. Like I said, that is how Asia moved away from a dollar, based, financing into domestic market. And now you see the story there. They really finance their own development with their own local currency and do not introduce unnecessary foreign currency, risks in their projects. So that's my comment on that. I think your second point was on
diaspora,
the political economy of the diaspora. Yes, I think all our countries. I'm from Zimbabwe, so for full disclosure, so we also have a similar, dynamic where we say there's a lot of Zimbabweans outside, and they need to contribute to the development of Zimbabwe. How do we tap into it? So the government of Zimbabwe, as an example, and other countries too, have now realized when they look at the remittances that are coming to the country, because we have a connection to the country, probably it's the second or the second largest, or if not the first source of, foreign currency inflows into a country. How do you tap into that? So they are creating ministries of dedicated to diaspora to say, if I need a passport and I'm in the US, I don't have to go all the way to Zimbabwe to go and get a passport for my child. But the local embassy could issue my child the Zimbabwean passport. So they are now governments are starting to acknowledge the presence of their diaspora and then facilitating them to feel the connection. It starts there. Because otherwise, why would I invest in a bond when I had to travel to all the way home to just get a passport? Yeah. So if the government is not helping to me, there's no connection. So it starts there with supportive governments must support their diaspora, acknowledge them as part of their community and help them access services that they would otherwise not get. And therefore, when they then bring, opportunities like we have a diaspora bond, there are instruments out there. People would subscribe, but it starts with the basics. That's my advice.
Thanks very much, Dr. Lena.
Yeah, I'll just add very briefly on the issue of diaspora. I think a lot of the successful examples come from governments that not only just tap into diaspora remittances for social development projects, but also really try to encourage the diaspora to be part of investment projects, right? So these remittances, when they are used more or less not as a replacement of ODI, but really channeled into investments, I think this is a much more successful model than just kind of relying on sort of remittances at replacing basically or feeding into kind of ODI. So I think that's just the point that I wanted to make. It's just sort of going beyond attracting diaspora remittances, but actually involving members of the diaspora as stakeholders as part of investment projects, not just kind of aid.
Brilliant. Thank you so much. And thank you very much to our excellent panel and our audience for these brilliant questions and reflections. We've talked about the higher cost of capital for African infrastructure. We've really discussed how that comes about. We've talked about different solutions ranging from building domestic capital markets. We've talked about specific structures in terms of lending of bonds. We've talked about the African multilateral financial institutions as a solution themselves, but also what countries can do, building capacity. We've talked about some of our other institutions that do build capacity and support. I'm really glad the African Legal Support Facility was mentioned. But of course, we're here at the World Bank and the IMF annual meetings. So the question is also, why would we have this conversation here? And my theory of change around that is that one of the reasons why we're here to have this conversation is because perhaps it can inspire and bring some of the ideas that are delivered by our institutions and also understanding of what's happening on our continent to the multilateral institutions. Because however much we say we don't want to come and beg, etc., these institutions have a footprint, they have a relationship with our continent. So we need to find a way to shape them also through best practice and what's going on here. Let me just mention briefly before I hand over to our very esteemed final speaker who's just joined us. The G20 African Expert Panel, which I'm on with some incredible people and headed by the former finance minister for South Africa, Trevor Manuel. We are working on a report that we'll be submitting to the South African presidency, and the South African presidency will present that report to the other G20 heads of state. That report, we will tackle questions around debt, we'll tackle questions around cost of capital. We'll be looking also at infrastructure, and we've had several inputs on these sorts of issues. We'll have very detailed discussions and preparations for it. But it is not the end of it will not be the end of the story by submitting that report. We do have a plan for continued work, and especially during the incoming presidency of the US and to beyond to the UK. So we will continue that work. So it doesn't mean that this is the end point, but we are really trying to make sure that we have a very strong pinpointing of what the solutions are, but also a very clear description of the problem from an African perspective. And I think this is what that African expert panel will bring, and I think is also reflected in the spirit of this conversation in this room and the partners that we have gathered here today. And we're very pleased to have that partnership. So all of that said, let me now turn to His Excellency Tariq Ben Yusuf, the Chargé d'Affaires for the African Union to the United States, to close off our discussion and really leave us with our inspiration for going forwards. Thank you.
Thank you, Hannah. Thank you for your leadership and your engagement for elevating African issue high on the multilateral agenda. Excellencies, distinguished colleagues, partners, and ladies and gentlemen, if you allow me, I would like to recognize in person Mr. Manuel Moses, the CEO of the African Trade and Investment Development Insurance, and Professor Dr. Lina Ben Abdallah, my dear friend Babajidu, and Pamela. Thank you, all of you, for making this event happen at a timely and critical moment in the multilateral system. It's a privilege to provide closing remarks today at this timely and thought-provoking dialogue. The African Union mission in Washington is proud to stand alongside AUDA-NEPAD, AAMFI, SAIIA, and the Development Reimagined in convening this important conversation on financing Africa's infrastructure. We are reminded today that Africa's development is not constrained by ambition, but by perception, and by the systemic inequities embedded in global financial systems. The $402 billion annual infrastructure financing gap is not just a figure. It's a reflection of the urgent need to recalibrate how Africa is seen, rated, and financed. As we heard, flawed methodologies of international credit rating agencies continue to distort Africa's economic realities. These inaccuracies not only inflate borrowing costs, but also undermine the continent's ability to deliver on Agenda 2063, our shared blueprint for inclusive growth and transformation. But Africa is not passive and reactive. In the face of these daunting challenges, we are responding with resolve. Through the African Union's debt management framework and the APRM sovereign credit rating reviews, we are building African capacity to assess and manage risk. Through the 5% agenda, we are mobilizing institutional capital to invest in transformative infrastructure. And I think this is critical in today's environment. Investment in infrastructure has to be sustainable, has to be predictable, because it's the one who will create and move the growth and job agenda. This is, I think, is of great importance for Africa to mobilize investment in infrastructure, but there is a huge gap that needs to be filled in spite of the high returns that investment in Africa infrastructure provides. They are the highest. And through platforms like today's, we are reshaping, reframing the narrative from the one of high risk to one of high opportunity. Let us leave here with a renewed commitment to African-led solution, to strategic partnerships, and to equitable financial systems that reflect the true potential of our continent. On behalf of the African Union mission to the United States, I would like to thank each one of you for your engagement, your insight, and your continued support. Let us move forward together with clarity, courage, and conviction. I thank you.
That's a perfect end. Let us all just give a round of thanks to our speakers, esteemed speakers, our panelists, and to all of yourselves for joining us this morning. This has been a series of events focused on Africa. Many of us were at another room at Capitol Hilton yesterday. Very pleased that we're having all of these different events, all partners coming together, coordinating to really elevate the African perspective here in Washington, D.C. So thank you all. Thank you. Let's all look forward to even more collaboration and action going forwards. Thank you.